In this video, we will do a quick recap of this reading, Fundamental Review of Trading Book, FRTB. At its core, FRTB is about shifting from using the VAR to using the more theoretically sound as well as conservative expected shortfall for the purpose of determining the minimum capital required for positions in the trading book. This expected shortfall has to be calculated at 97.5% confidence using stressed market conditions and using asset class specific liquidity horizons. So liquidity horizon can take one of 5 possible values: 10 days, 20 days, 60 days, 120 days and 250 days. Okay. A quick note about this choice of 97.5% confidence. If you were to assume that your losses are normally distributed, then you will observe that the expected shortfall calculated at 97.5% confidence comes very close to the VAR calculated at 99% confidence. Okay, so that is where this 97.5% comes from. Please note that the approach which uses the expected shortfall for determining the minimum capital required is called the internal models approach, and the approval to use the internal models approach is not granted on a bank-wide basis. This approval is granted on a desk level basis, a trading desk level basis, and even if a trading desk has the approval to use internal models approach, it still has to also compute its minimum capital required using the standardized approach. Once you have numbers available for both the standardized approach and the internal models approach, the capital required will be computed as the higher of a certain multiple of the number coming from the standardized approach and the number coming from the internal models approach. Very quickly, let's take a look at the standardized approach. There are 3 components here. Component 1 is a component which is calculated using risk sensitivities. We take the trading book and we categorize all positions in the trading book into 7 risk classes. We can think of each of these risk classes to be a trading desk. So 7 risk classes will be equity, FX, interest rates, commodities, and 3 risk classes associated with credit. For each of these 7 risk classes, we compute 3 sensitivities. First order sensitivities, delta and vega, and second order sensitivity, which captures the curvature risk. Okay. For each of these 3 sensitivities, we compute a risk charge. For delta and vega, the risk charge is computed using this formula, a formula which is very similar to the formula which we use for determining the volatility of, let's say, a basket of stocks. A few changes required. The weights or allocations in the basket volatility formula, they get replaced by the appropriate risk sensitivity. For delta charge, you will use delta here. For vega charge, you will use the vegas here. Okay. Then standard deviations in the basket volatility formula, those get replaced by worst case shocks in your risk factors. For any given risk factor, the worst case shock can be calculated using a very simple formula like this. You start with the daily standard deviation or volatility of the risk factor picked from a stressed period, scale it using the square root of time rule to get to the volatility corresponding to the liquidity horizon for that risk factor, and then further scale this number by a multiplier to arrive at a worst case shock. This multiplier assumes the normal distribution assumption. This multiplier is the same number which the volatility of losses, sigma, get scaled by when you compute expected shortfall at 97.5% confidence. So this number would be a number close to 2.33. Now, we don't have to worry about how worst case shocks are calculated because the values of these shocks along with stressed correlation numbers are provided directly by the Basel Committee. Okay, the bank, it only needs to provide the level of the risk sensitivity to each of the risk factors. Okay, so this is about computing the delta charge and the vega charge. Once we have the delta and the vega charges for all 7 risk classes, they are simply added together. That means we do not allow for any diversification related benefits. We also have to compute a charge corresponding to curvature risk. We are not going into the details of how this curvature risk charge is computed. The end goal is to compute a risk charge corresponding to all these 3 types of sensitivities and aggregate all these risk charges across the 7 risk classes to arrive at the number corresponding to this component 1. Okay? Then, to take into account the credit risk exposure of the positions in the trading book, we have component 2. Credit risk, we know it stems from changes in credit spreads and from jump to default risk. The portion which comes from changes in credit spreads, that has been already accounted for in component 1. To account for jump to default risk, you compute a default risk charge using a simple formula that looks something like this. Exposure, that times a default rate, or let's say probability of default, that times a loss given default. Again, in this formula, the default rate and the loss given default, both of these, they come from the Basel Committee. The bank, it only has to supply the level of exposure. Okay? Then, for those exotic positions which cannot be accurately and reliably represented in the form of simpler positions, let's say positions on the underlying assets, and also let's say positions on vanilla options on underlying assets, for those exotic positions, we also need to compute a component 3 because these positions have what we refer to as residual risk. So we need to compute a residual risk add-on, which is very simply computed by taking the size, or let's say the notional amount of such an exotic position and multiplying it with a risk weight, which again is specified by the Basel Committee. For exotic options, risk weight is 1%. Okay, so this is about the standardized approach. Let's now move on to the internal models approach, an approach in which, in a sense, we have to calculate the expected shortfall. Now, a popular method to compute expected shortfall is historical simulation. We need to work with 10-day shocks. These 10-day shocks need to be sourced from an appropriately chosen stressed period. Banks, they do have the flexibility to choose an appropriate stressful period depending on the nature of the positions in, let's say, a given risk class. Okay, so we need to compute this set of 10-day shocks using overlapping periods. To compute the expected shortfall for any given trading desk, first of all, we have to categorize all our risk factors into 5 categories. This is in accordance with the liquidity horizon of any given risk factor. So all risk factors which have a liquidity horizon of 10 days, they go into category 1. All risk factors with liquidity horizon of 20 days, they go into category 2, and so on. To compute my expected shortfall, I need to compute 5 different expected shortfalls and then aggregate them together using this formula. To compute the first expected shortfall, let me call it ES1, I'll be shifting all risk factors across these 5 categories by their respective 10-day shocks. That will give me ES1. To compute ES2, I will not shift risk factors in category 1. I'll be shifting risk factors in categories 2 to 5. Okay, that will give me ES2. Once I have ES2, I'll be adjusting this ES2 number using the square root of time rule to make sure that all risk factors which are in category 2 in effect do use a 20-day liquidity horizon. Okay, and I keep proceeding like this. This is the formula to calculate the expected shortfall. Now, please note that the stipulation is to use overlapping periods. When I use overlapping periods, then these 10-day shocks may not necessarily be independent. This reduces my effective sample size. It does lead me to noisy results, but these results are still unbiased, and the Basel Committee therefore prefers using 10-day overlapping shocks as compared to using 1-day shocks. Okay, then a quick note about how backtesting will work when we shift from VAR to expected shortfall. Please note that expected shortfall as a risk measure is difficult to backtest. That's number 1. Number 2, if this expected shortfall is computed using a stressed historical period, backtesting becomes even more difficult. Therefore, backtesting as per FRTB stipulations will be done using a proxy risk measure, which will be the VAR. This backtesting will be done using the 1-day VAR using the recent most 250-day historical period. Okay, so we'll be backtesting VAR calculated at both 97.5% confidence as well as VAR calculated at 99% confidence. Okay, the threshold limits for the number of exceptions is 30 exceptions for 97.5% VAR and 12 exceptions for the 99% VAR. Okay, so if these conditions are not satisfied, which means that number of exceptions in this case and or the number of exceptions is in this case, they are greater than the specified limits, the bank will have to switch back to using purely the standardized approach. Okay, also another way of backtesting is by using the p-value approach. Essentially, in this approach, on a daily basis, we will be calculating the probability that your PNL is less than, or let's say to the left of, the actual observed PNL. This probability is calculated using the same PNL distribution which is used by your VAR model. If that PNL distribution is indeed accurate and let's say close enough to the unknown distribution from which your actual PNL comes from, that means your model is good to go. And in that case, what you will observe that the daily p-value that you obtain will be uniformly distributed with lower limit 0 and upper limit 1. Okay, then another way of doing backtesting is by doing a PNL attribution. Please note that because your trading book is exposed to a multitude of risk factors and data available with you, and also the choice of your stressed period may not do justice to all those risk factors which your trading book is truly exposed to, what you do is that you actually work with a subset of risk factors. And the PNL which we get using the subset of risk factors is referred to as, let's say, a model PNL. Okay. Therefore, on a rolling basis, if I were to calculate the difference between the actual PNL and the model PNL, let me call it U. U bar denotes the mean of this U over, let's say, a rolling time window. Then the ratio of U bar to the standard deviation of the actual PNL, denoted by V, this ratio should be between minus 10% and 10%. This ratio essentially tells me how biased or unbiased my model PNL is. Okay. Also, the variance of U divided by the variance of V, this ratio should be less than 20%. Okay. So on a daily basis, I am computing this ratio and this ratio over a 12-month period. If at all these ratios do not satisfy the conditions which have been imposed on them, let's say 4 or more number of times, then again you will have to switch back to using the standardized approach. Okay. Now, when I use the internal models approach, how do I tackle credit risk exposures? Again, we know that credit risk can come from changes in credit spreads and from jump to default risk. When I talk about credit spreads, these are market observed variables, and expected shortfall computations will take into account this source of credit risk. Usually speaking, we see that credit spreads, they have liquidity horizons of 20 days and 120 days. Credit spread volatilities, they have liquidity horizons of 120 days. Okay. Then when it comes to jump to default risk, this will be captured by computing something like an incremental default risk charge, which essentially is the credit VAR computed at 99.9% confidence and 1 year horizon. Okay, so essentially what we are saying is that the incremental risk charge which the Basel 2.5 introduced has been changed to these stipulations. Credit spread risk is tackled by this formula. Jump to default risk is tackled as if this particular position belonged to the banking book. The incremental risk charge, it introduced this constant level of risk assumption, which was a very simplifying assumption, and that assumption is not carried forward in the FRTB. Okay, then when it comes to securitizations, I mean those positions which are sensitive to default correlations, then Basel 2.5 had introduced the comprehensive risk measure for these kind of positions. The CRM, comprehensive risk measure, can be computed using either the standard approach, the standardized approach, or the internal models approach. Okay, because the internal models approach generally leads to a lot of variability, especially for these very complex positions, FRTB stipulates that for securitizations, it's only the standardized approach which will be allowed. Okay, then lastly, FRTB makes the distinction between trading book and banking book less subjective and more clear. For a position to go into the trading book, it's not just sufficient for the bank to have an intent to trade on these positions. The intent is not sufficient. The bank, it should also have the ability to trade. That means there needs to be a dedicated trading desk for this type of position. On a daily basis, the bank therefore must have the capability to manage, I should say risk manage such positions. Then, if a position goes into the trading book, day-to-day changes in, let's say, the market value of these positions should affect the equity of the firm and also pose a risk to the firm's solvency. Reclassification of trades becomes stricter. Reclassification will only be allowed under extraordinary circumstances. Let's say when there is change in accounting rules, or for that matter when there is a closure of, let's say, a trading desk. That would qualify as an extraordinary situation. Also, no capital benefit will be allowed to be recognized because of a reclassification. The capital requirement, which was, let's say, in place prior to any reclassification, will stay put even after a reclassification has been done. Okay, so this video was about a quick recap of this reading, Fundamental Review of Trading book.